is because a lot of time in real estate, you're buying an asset and you think about the appreciation.
Right.
Every time that I collect money, the value of my asset actually goes down. How someone can get into note investing, you don't necessarily have to be yourself investing in notes. Diversifying your real estate investings. First, we get into real estate, one reason is to diversify our investments as a whole. We probably all play, but then note investing is another sub-level or another kind of diversification within your real estate investments.
Thanks for joining us on another REI-NWA podcast. This is podcast number 46, and I'm your host, Coley Bailey. I'm the principal broker at Lone Rock Realty, and today I've got with me Josh Cox.
Coley, nice to see you as always.
Yeah.
Excited to be here, excited for this program coming up. Got that panel with some other great people, and I think we've got a good topic.
Absolutely, man. This is going to be a good one. So today we're going to be talking about diversifying your real estate investing. The program that's coming up is going to be about all kinds of alternative types of investing, like mortgage notes, syndications, getting into foreclosures, things like that. Today, we're mostly just going to be talking about mortgage notes, which is your specialty.
Very fun topic.
Yeah. But before we dig in too far into that, tell us who you are, where you're from, how'd you get into doing what you're doing now?
Yeah, thanks. Again, I'm Josh Cox. I'm with Bridge City Factors. Bridge City Factors is the management company for a couple of note investment funds. So we manage those and we raise money. But how I got here was, kind of all my life I've been interested in finance and economics. And I think I said when I was 12 years old that I'm going to go to school and dual major in finance and economics. Well, that didn't happen. Ended up studying business overall, but my background, my career actually comes from kind of that sales and marketing and technology space. I've been with some startups here. I'm originally from Portland, Oregon.
Okay.
Moved out here in 2017.
All right.
Work kind of took me out this way and met someone and moved out here. So I'm not doing long distance. So I came out here. But kind of in that time, growing up, my dad has been in the mortgage industry for 40 years and in the real estate business as well. And I was kind of worked on things with him, and then closer and closer over the years, he discovered mortgage note investing many years ago, and I jumped on board that. We'd been doing some joint ventures, which people have their opinions on that, whether it's securities or not. And we wanted to be able to raise more money and use other people's money, invest with them. And so we went the full Reg D in 2019 is when our first fund started.
Okay.
It was a 5-year fund, so it's actually winding down right now, just as Fund 2 is ramping up.
Wow. And
it couldn't be at a better time because this is a great market to invest in mortgage notes.
Yeah. All right. Well, let's talk about that a little bit. So, and again, we've got the main meeting coming up, which is about alternative types of investing, and we should talk about some of the other speakers too. Obviously, we've got you, and then we've got Wes Fikes, who, if you haven't seen his podcast, go watch it. It's phenomenal. Three Ways to 96K. It was a really good one. And then we've also got Sam Harris, who's the president of Armstrong Bank, and he's going to be talking about foreclosures and stuff. And Wes is talking about syndications. So, okay, mortgage notes for the layperson who just hears that word but doesn't know what it means. What is that?
We buy paper.
Okay.
If you've ever had your own mortgage and then you get that letter in the mail that says, you now send your payments to this person, or this person now owns your mortgage. I might be one of those people.
Okay.
Basically, there are, the institutionally originated loans, mortgages, notes. But then there's a secondary market because banks are always moving things around. Other lenders, they're moving around. There's a very active second and third market.
Yeah.
We typically buy the mortgage or the right to that loan, to those payments, secured by residential real estate. So I focus on first position notes in 1 to 4 family residential. That's our sweet spot.
Okay.
You can have performing notes where they make their payment every month. Mm-hmm. Boring as that. They make their payment, collect the money.
Yep.
Then there are kind of mid-performing where they don't pay every month. There's a little hair on it. And then there's non-performing. Those are the ones that are in danger of going to foreclosure.
Okay.
Now, your traditional institutions may or may not be able to help borrowers be creative, find creative ways to keep them in their homes. Mm-hmm. And that's just because they're large institutions.
Yeah.
Investors or a fund like us, we're able to actually work with borrowers as best that we can, pay them that specialized attention and find solutions, whether it be modifying existing terms or just making some changes or finding repayment plans with them. Because usually when people are having trouble with their mortgage, it's a temporary thing that comes up in life. Yeah. Something happens.
It's a lost job. It's 6 months of not being able to find a job, and then it's coming back. Yep.
So we're able to help them get back on their feet. And it's a great way to invest. Our investors make a good amount of money, and we help the borrowers as well. And that's just kind of the tip of the iceberg on.
Yeah.
But that is what it is to invest in mortgage notes. You're buying and selling the paper. It's kind of like being a landlord.
Yep.
We call it being a lien lord, except we don't own the property. We're not on title, but that means we don't have to deal with the 4 T's: the tenants, termites, toilets, or taxes.
Yep. Just the paper.
Just the paper.
Fantastic. All right. So, how would one get started in investing in mortgage notes?
Yeah, it's one of those, I've got a 10-year-old who loves golf and he gets frustrated. And we have a joke that says golf is an easy game that's hard to play.
Yes.
And there's a little bit of like that to note investing as well. There are a lot of intricacies, especially when you're doing it in multiple states, different compliance rules. You want to have the right vendor networks set up. But I guess really the short version is, how do you get into it? Mm-hmm. You buy a note.
Yeah.
You just do it. It's like it's kind of like any of your first real estate deals. You just have to do it.
Yeah.
But it's a great community out there. There's always resources for people a lot of resources to learn. Official paid courses, programs, there's some really great ones out there. Some people, in fact, most people come from something in the lending or real estate industry. I meet a lot of people that ask them, how'd you get into it? And they say, well, I own 200 properties and rented them out, and I got tired of it. And so they'll sell them off.
Yep.
They'll sell them and invest in notes, or they'll sell them with owner financing.
Right.
So then they now are carrying the note.
Those notes, yeah.
And then they can sell that note or sell partials where we don't have to get into that. But that's a fun little thing if you want to look it up.
Okay.
Where you can, if you have a note that has 15 years left on it.
Yeah.
And you want to sell the rights to 3 or 5 or any number, you can sell it off to someone, which can be a great way if you buy a note, recapitalize by selling off some of the front end or back end, however. So you can be as creative as you want. And then when that period is done, payments can come back to you.
Huh.
Just a little fun side bit there.
Interesting. Wow. How much should someone expect to invest in this? How much cash do you need coming into it? Can you partner with people on these things? I don't know. What are some of those details?
Yeah, really, it can be a whole range because we aren't, and that's another fun thing or caveat with notes, is because a lot of time in real estate, you're buying an asset and you think about the appreciation.
Right.
Every time that I collect money, the value of my asset actually goes down. I'm collecting the debt.
Yeah.
So I don't worry as much about the appreciation side of it. We're looking at what the balance is and on the note. And you can buy things from a few $1,000s, $20,000, $200,000, $5,000. It really is anything that a mortgage was written for, and whatever balance in its timeline is, you can probably buy out there.
Yeah. And people forget that someone might buy a $250,000 house and have $200,000 in cash that they put down, and they only actually finance $50,000.
Exactly.
Right? So people forget that there is a pool of smaller mortgages out there.
Absolutely, especially. You're right. But you do bring up. You asked another how someone can get into note investing.
Yeah.
you don't necessarily have to be yourself investing in notes, because, well, I said, it's an easy concept that can be difficult to do because of all those intricacies. A great way that people get involved in notes is investing in a fund.
Right. Okay.
Because there's a whole lot of great reasons to do that.
Such as Bridge City Factors, maybe?
Bridge City Factors is a great manager, and there are many of them. But, someone, that's their job.
Yeah.
Because, the idea of investing in notes is also that passive investing. We always hear about mailbox money.
Yeah.
It can be a little bit more than that to really manage a portfolio of any size.
Right.
But you get that experience from the manager. But the really cool thing, there are two really things that I love about it, being part of a fund, is one, if we're talking about diversifying your real estate investings, first, we get into real estate, one reason is to diversify our investments as a whole. We probably all invest in the stock market and in other things.
Right.
So that's just a piece of your portfolio. But then note investing is another sub-level or another kind of diversification within your real estate investments. And when that third level is when you pool your money with other people, you're not just buying yourself one or two or three notes and building a portfolio and all your money is all in that or just in a few. You can pool everyone's money in a fund. And you're buying more assets in more areas, in more asset
more
classes,
diversity,
more diversity
group,
just as a group. And because you have that larger pool of money, say you're working with 40 million instead of 200,000,
right?
You get certain economies of scale.
Yeah.
You have access to more premium vendors. You can move up the food chain. You're buying closer to those original institutional lenders instead of things that have been sold over the market many times. So you're getting closer to the source. You can get better deals. You can buy in bigger pools and get better deals.
Yeah.
And you can build a better team.
What kind of returns are people seeing on some of these? And I'm sure it's all over the board, but what does that kind of look like?
It's different, of course, from performing to, the more or the less performing that it is, you're probably going to be able to buy that at a bigger discount.
Okay.
But, 8 to 14, 16%, kind of average across a portfolio is pretty good. In fact, I'm excited for this panel coming up that we're talking about. And I know Kathleen was saying there's a lot of people that are just kind of waiting. They're in a holding pattern because interest rates are so high.
Right. Yeah, buy and hold is very difficult right now because, first of all, appreciation has kind of flatlined.
Mm-hmm.
Yes, you get to count depreciation, but cash flow is really hard to get.
Mm-hmm.
So, just some of the normal things that long-term buy and hold investing provides are kind of strained right now.
Yeah, my thought was you can wait until mortgage rates come down, say they're 8%
right.
for something, or wouldn't you want to make 8%?
Yeah,
you can be the bank and be the lender, and right there, just as it's written, your yield. If you write a note at 8%, you're making that.
Yeah, fantastic.
Pay less for it, you can make more. There is a lot of opportunity to quickly see returns and recapitalize and do it again. That's the thing with notes too, is it doesn't take long. You can close a deal in days or weeks. It's really as long as your due diligence takes.
Wonderful. All right. So we've got a main meeting coming up. It is going to be on September 10th, 2024 at the Hyatt House in Rogers. We'll get started at 5:30. You can sign in, mix and mingle, get some networking in, and then we'll actually kick off the main meeting at 6 p.m. So, of course, we're going to have Josh Cox, Wes Fikes, and Sam Harris on the panel. So it's going to be a powerhouse of a panel, so you don't want to miss that. As usual, it's $0 at the door. If you are an REI-NWA member, 20 if you're not.
And I don't know why you wouldn't be.
I don't know why you wouldn't be, because we have 4 meetings a week, or not a week, that'd be way too much, 4 meetings a month. So you can fill your calendar all throughout the year with real estate investing topics for very little money. Mm-hmm. Just check it out on REI-NWA.com. You can sign up right there, and then you get access to years worth of backlogged videos of all the programs that we've done for the last, 5, 6, maybe 7 years.
Yeah.
There's a lot on there.
I haven't caught up yet.
Yeah, no. So there's a ton on there on the private YouTube channel. With that being said, thanks for this. This is a fantastic topic. I mean, we haven't had anybody on the podcast talking about this yet. So,
all right, we're gonna have a lot of fun.
Yeah, man, it's gonna be a great show, and appreciate you being on the podcast for sure. All right, guys, that's it for this one. We'll catch you on the next one.